So I'll be honest guys, when I finished this script, it was originally before this week started when the markets got punched in the face. So I made some minor edits, but nevertheless, I still hope that by the time you watch this, it's still relevant and it's still gonna help you out. In preparation for exactly this kind of instability, I was thinking about this question about how do I protect my portfolio in the months to come. The instability that you're seeing in the markets is really just a symptom. So underlying all that is some data that's making it a little bit more worrying. And that's exactly what I'll be covering. And on top of that, of course, should you want to protect your portfolio, what are some of the options that you have? Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending and investing. So right up until this week, markets have gotten off to a good start so far in 2021. We're at all-time highs when it comes to margin debt. And what that simply means is that people are so optimistic and money is so cheap, so they're willing to borrow it and throw it into the markets. Next is that the number of call option contracts are skyrocketing. And for those of you who don't know, call options are simply different type of contracts that people buy to make bets that the market is going to continue rising. And the backdrop to all of this happening is this other thing called the CAPE ratio, which is basically just a measure of how expensive are the markets. And what's interesting is that lately, the US markets have the highest CAPE ratio since the 1990s. And the only other time in history that it has been higher is right before the dot-com crash in 2000. And for the past week or so, the one big fear and trigger of all this market instability is really inflation that's potentially rising. So whoa, does this mean that we're in a bubble? Is the bubble still inflating? Or is the bubble gonna burst anytime soon? Who knows? The truth is, nobody can accurately predict when it's gonna happen. So it doesn't matter about what the situation really is, but we are seeing it in the markets and we are faced with a decision. What do we do? What are our options that we can really consider and think about? The first option is to literally do nothing. What are you talking about, man? After all that? So market timing is really difficult. And not many people in the world can do it consistently because if they could, hey, they'd be billionaires. So if you happen to be a long-term index investor, especially if you subscribe to the FIRE movement and really just consistently investing regardless of what happens, come rain or shine, it is a perfectly valid move. Plus, from what I'm reading, it should comfort you to understand that in history, market corrections are usually defined by a roughly 10% pullback from the highs. And when that does happen, it's usually a 3 to 4 month time period before markets rise again to cover those losses. More serious bear markets, however, are usually defined as declines of anywhere between 20-30%, and those can take up to about 24 months to recover. Now, the 2020 bear market was a little bit of a strange one because that was the shortest bear market in history. All those are just averages, and while it might be painful to sit through and wait it out, if you were investing consistently from the decline all the way back up to the incline, again, you will end up in a better place overall. Now, this is especially true for those of you who happen to be using robo-advisors because a lot of those portfolios there are actually built for the long term, and some of them might even be holding assets that help to protect against some market correction. So yes, it might be worrying to see some of the declines in the past week or so. Nevertheless, hang tight. They were built to withstand that. And a couple more strong supporting reasons of doing nothing is really that there's a lot more expectation of money about to flood the markets in the near future. Because what happened with 2020 is that you had a large injection of stimulus cash in the US, and that really propped up a lot of asset prices. And the second reason is that Jerome Powell, who's the head of the US Federal Reserve, he's really just recently indicated we're going to do all we can to support the economic recovery of the worker in America. And that's a good sign because that hopefully provides a lot of stability that people want. So yes, even if the markets were to correct, you would have to sit through some level of discomfort, but at the end of the day, you should likely make it out okay if you continuously invest. And on top of that, if you don't panic sell, and please don't do that. What you should do instead is click that like button because that tells the gods of YouTube that this video is okay and you can share it out to more people in the world. The next easiest and cheapest option that you can consider is really to reduce your position. If you happen to be 100% invested and have seen some pretty good gains so far, there's nothing wrong with you selling down some of that position to sit on more cash. If you do that, you have to consider a few things beyond just transaction fees. The first is potential opportunity cost, where if you do reduce your position and the position continues to rise, yes, you'll be foregoing some more of those extra goodie gains, but hey, it's something that you got to live with if you want to de-risk. The second key thing to remember is that if you do reduce your position, you also have to rethink about when exactly you're going to re-enter the market. Because there's nothing worse than pulling out of some of your position and then realizing that, oh my god, I don't know what to do next. A variation of selling off your position is to use certain stop losses. Depending on your investment approach and gains so far, you can just determine a price point where you feel that, hey, I'm comfortable if the price plays above this band, but once it hits this mark, I'm out of here. The next few options are really all forms of diversification. The first option is that if you happen to be holding a very concentrated tech portfolio, or maybe the QQQ, and you still wanted some level of tech exposure moving forward, you could simply look at buying the S&P 500 itself. The SPY, after all, is still quite tech heavy, with about 33% of its portfolio allocated towards tech stocks. The second scenario could be like maybe you're a big believer in the US markets like I am, but you want to reduce your exposure to some of those big tech names. Many would consider an ETF like the VTI, where it's a total US stock market, but unfortunately 22% of its value resides in the top 10 stocks, and 7 out of them are really tech stocks. So it's still skewed a little bit towards big tech. So the less common alternative here is to use an equal weighted fund. It simply means that each stock in that ETF is weighted equally, so therefore it doesn't tilt towards certain big names. You could find them easily with ETFs like RSP, which is the equal weighted S&P 500 fund, or you could use something like EUSA, which is the equal weighted total US stock market. A third option in a market where it's so dominated by big tech is to actually tilt your portfolio towards value stocks instead. And you can invest in them by picking your own value stocks or using simply an ETF like BTV. The fourth scenario is that you could really be feeling that, US markets are really overpriced right now and I might want to consider broadening my horizons. An easy option would be to look at an ETF like VT, which is the total world market. It holds about 8,700 stocks. And on top of that, about 58% is allocated towards US stocks. So that way, you still get the best of a market that's really popular, and on top of that, diversify far enough that you have a lot of balance in the world. If you were a little bit more adventurous in diversifying, you could maybe even look at specific regions like emerging markets, and you can do that through a simple ETF like IEMG. Or if you're even more adventurous, you could buy specific countries. Like for me, I own a little bit of China, and I do that through an ETF called CNYA. Of course, the more specific you get, the higher the risk. So regardless of whatever it is, please do your own due diligence if you want to go into those specific regions or countries. The final form of diversification is to consider assets that are not very well correlated with stocks as a whole. The first popular option is to consider bonds, which usually act as a bit of a ballast that balance things out when stock prices go down. A popular ETF to do that with, at least with US bonds, are BND, where it's the total bond market in the US. And the other option is gold, which usually is thought of as a bit of a safe haven, where when people are afraid of what's happening in the stock markets, they tend to pull it out towards safer, more stable assets like gold. And you can do that simply with an ETF called GLD. Now, there are some that will look at cryptocurrencies as a complete different asset class that is uncorrelated with stocks. And while that might be true, the reason why I'm not really comfortable recommending that as a real kind of a safe vehicle is that they're really so volatile. So should you choose to do so, please do so at your own risk. Or if you happen to have very strong thoughts about cryptocurrencies as playing this role, hey, let me know. So I really hope this video has helped you kind of think about the different decisions that you could make. And if you got value out of this, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video. And until then, I wish your portfolio good luck. You take care. and keep playing your own game.